It is a confusing picture for oil this morning. The International Energy Agency says oil demand will increase faster than it expected in 2011. And the U.S. Department of Energy says that crude prices will average more than $83 a barrel next year, up about $4.35 from 2010. But oil futures have been dropping this morning below $80 a barrel. With us to sort it all out is Colin Fenton, CEO of Curium Capital Advisors in Boston. Colin, you have said that fair value for oil is way below $80 a barrel. So I have to ask you, what's wrong with the DOE's analysis, given that they expect prices to keep rising?
Well, back in April, we started getting a lot of negative signals from the fundamental and technical pictures. And as you know, we were very bearish going into May and June, not only in commodities, but in equities. We had a target for $65, down from 100. And we did see 100 in gasoline per barrel in April, and we did get to 65 in the spot market in crude. I think the important takeaway is that the negative forecast has already validated. We're seeing a lot of forecasters chase the last couple of months, and importantly, in the last 2 weeks, it looks like demand in China is actually stabilizing, even as crude runs through refineries are slowing. And so I think actually looking out into 2011, the DOE and the IEA forecasts are probably correct. But a change has happened here with the Federal Reserve giving us the floor on its asset purchases, a change in policy. In Europe, we've seen the stress tests, which some believe were not as stressful as they could have been, be accepted without much question. So I think that investors should be prepared to actually turn more positive on commodities and reserve their skepticism perhaps for equities.
Okay, that's a very important point. Explain to us the supply and demand picture. You talked about less gasoline going through refineries. Is it a question of enough capacity being taken out of the system and demand rising? The IEA and the DOE both expect demand in the order of 86 million barrels per day, give or take one or two on either side of that in 2011.
Yeah, I mean, we're on a knife's edge here, so small changes make a big difference. And there's no doubt that one of the most important drivers of price across all commodity sectors has been supply cuts or unintended supply reductions through weather, as you see in sugar and wheat. I think that the thing that has changed is that the end-use demand in the construction sector has improved, as we can see looking at nickel prices, antimony prices, other very esoteric rare earth prices that are not traded on futures markets. And if we do see any kind of supply reduction, either intentional through the reduction of the crude that goes through a refinery, or if this storm in the Gulf or any other weather disruption affects crude production, we'd see the balance tighten that way. So I would say we're more constructive than we were before, but we're certainly not raging bulls. This is going to be a tough road ahead.
Colin, you mentioned wheat, and I do want to ask you about wheat, given the extraordinary images that we've seen coming out of Russia and the wild price action in wheat. In July, you correctly predicted the run-up in wheat, maybe not to $8 a bushel, but you said that the droughts in Russia and Australia would drive wheat prices higher. But as of Friday, you're telling investors to take profits effectively, get out of those positions. Why is that the case? The drought and the fires continue. The Canadian wheat harvest is going to be down some 21%. How does it all work out for you?
I mean, the devastation and suffering have obviously been very profound and worse than we expected. We did expect to see a sharp upward movement in price, not to above $8 in the spot price, and so that surprised us, the scale to there. But we did think we could get up to $7 and an average price of $5.75 for the year. So we just think it's time to take some profits here on the position. We do think that wheat prices will remain at an elevated level, but in the near term, we are already starting to see some effects in price rationing, and that includes the export bans that Russia and other countries have considered.
Colin, we have about 25 seconds left, maybe 20. What is an elevated level? Where do you think wheat's going to stabilize?
I think it's going to be over 6. We had a forecast of 5.75 for the entire crop year, so we'll probably have to take that up. The important takeaway is that inflation probably is starting to get sticky in the economy, which is actually a good thing from the Fed's perspective. And so we're actually more positive than we were before.
All right, Colin, it is always great to have you. And Colin Fenton saying it right there. Wheat prices probably going to average higher than $6 a bushel, and the Fed praying for, in fact, a little bit of inflation.